Welcome back to Buy or Die. We make money on perspective stocks, and I have no idea why you're still not with us. Subscribe, hit the like button, and let's go. For many investors, the words stock market crash are enough to send shivers down their spines. But the fact of the matter is that a stock market crash is a given. To be fair, we're never going to know ahead of time precisely when a crash will begin, how long it will last, or how steep the decline will be. In many instances, we won't even know what the catalyst is for big decline until it's well underway. But what we do know is that the benchmark S&P 500 has undergone 38 double-digit declines over the past 71 years. That's an average of one double-digit percentage decline every 1.87 years, and it demonstrates how commonplace crashes and corrections are to the investing cycle. At the moment, there are more than enough catalysts on Wall Street to push the broader market considerably lower. For example, history clearly doesn't favor the market over the near term. Following each of the previous 8 bear market bottoms dating back to 1960, there was at least one double-digit percentage decline within 3 years. This suggests it's highly unlikely the near-perfect bounce we have experienced from the March 2020 bottom continues unabated. Valuation remains another glaring concern. For the past 6 months, I have been pointing out that the S&P 500's Shiller price-to-earnings ratio has been climbing. The Shiller PE takes into account inflation-adjusted earnings over the past 10 years. There have been only 5 times in history where the index surpassed and held a Shiller PE of 30. Including right now, and the previous 4 instances subsequently resulted in the S&P 500 losing at least 20% of its value. There are other factors at play beyond history and valuation too. Inflation has been picking up in a big way and could tighten consumer wallets. There is also a growing likelihood that the Federal Reserve could take its foot off the proverbial gas pedal with regard to monetary policy and quantitative easing. And don't forget about the coronavirus Delta variant, which threatens to slow down reopening efforts in various parts of the US and around the world. We might not be able to pinpoint exactly when a crash will occur, but at this point, downside is inevitable. However, bad news is actually good news for long-term investors. That's because crashes and corrections allow investors to scoop up highly quality stocks at a discount. A lot of them seem attractive already at the moment. For example, Intel, now it's about $53. Good price for picking. Another one is TAL Education. It lost 70% yesterday because of probable China regulations of educational companies, but even taking this factor into account, $6 for TAL is like a sale. It's definitely going to surge. The price was dumped to let deep pockets buy some shares. You can also pick, something from Russell that was affected by this fear of new COVID-19. For example, I like Cinemark Holdings. For a long time it floated above $20 and now it's like $15, $16. There is also a good price for buying. Actually, a lot of stocks crashed over the last 2 weeks. If this correction continues, you can pick some of these companies even for better price, but you can start now, step by step, buying small portions of shares, because probably there is no serious market crash coming, and we might see reversal next week or at the beginning of August. No one knows the future. Just try to buy the dip to benefit from this situation. I'm waiting for your stock market predictions in comments. I'm waiting for your subscriptions because it's much better to make money together. And see you guys tomorrow in the next video. Bye.